June is on average one of the worst months of the year. And we saw that in the Nasdaq. We didn't see it so much in the S&P. I mean, if the worst month of the year is you're down like 1.5%, that's not a big deal. And the Dow was up.
I mean, you look at these charts and there's been very little volatility this year.
Yeah.
I mean, compared to prior years. I mean, certainly there was a bit of a drawdown in April, but looking at this, the line has been pretty flat for the most part.
Welcome to the Compound Growth Podcast with Colin and Wheeler, where we talk all things growth, from financial growth to career growth, personal development to societal progress. We explore how each layer builds on the next, compounding over time to shape who we become. Each week, we break down complex ideas and emerging trends into clear, actionable insights. Because growth isn't just about numbers. It's about understanding the world and our place in it.
Yes.
Okay. Let's get into just a quick market recap. How about that?
Yeah, so June 2026.
June 2026. A lot happened and nothing happened at the same time. Let's start with the last chart I sent you, Colin. That is showing the markets month to date. So that's basically just a snapshot of June. We're actually recording this on the 1st of the following month, on July 1st. That never happens.
We're being very timely.
Yeah, it's nice that we're recording this and it's actually we can see the full month.
Yes, exactly.
It's nice.
Yeah, it is exciting stuff.
So real numbers here. What's interesting to me about this chart is you can see the Nasdaq at the bottom. We talked about it recently. You were like, "Hey, the Nasdaq's off 6%." I'm like, "What?"
Yeah, I know.
Didn't feel like it.
Yeah, it was 6.6% towards the end of June, and then it's since recovered a little bit. But yeah.
So down almost 3% on the month.
Yeah.
The S&P was roughly, let's call it flat. But what's interesting is we're seeing a rotation in the market, right? You can see Nasdaq being down, the Dow being up. That demonstrates rotation. On top of those indices, you have the Russell 2000. So the smaller U.S. companies, right? And they had a really strong month, up 3.6%.
Yeah, they did. So a bit of a shift this month. I'm curious why you have the Taiwan index in here.
Yeah, you're about to find out.
Okay.
All right.
Good.
So you can see that Taiwan in there in pink, let's call it pink, fuchsia, something like that. Grab the first chart I sent you, and you're going to see year-to-date numbers for those indices.
Okay, got them.
So now we're looking at the Dow, the Nasdaq, the S&P. They're all pretty good. Let's call it 10%, give or take. Right?
Yep.
You've got the Russell 2000 having a great year because we see that broadening out in the market.
Yeah.
Right?
Yep.
Hey, what's happening in Taiwan?
Why is Taiwan up 62% year to date?
Well, because Taiwan is basically like two companies.
Right.
And they are both AI. Right. It's Taiwan
Semiconductor,
right? So what's interesting to me is this you look at these charts and you're like, why is Taiwan there? It tells the story, right? You could have Micron in here, but Micron's not an index. What are your thoughts on where we are right now?
I think that honestly, the market being, if we were to rewind the clock a little bit, and if I think about this from a planning perspective, all of our planning software, if we go for growth, meaning that we have options within a client's financial planning software where we can do conservative, moderate aggressive growth.
Yeah.
And a conservative portfolio, I think, is 2 to 2.5%. Is basically like the rate of return that it applies on a linear level.
Yeah.
And then if you go for growth, which is the highest default one, is basically between 7.4 to 7.8%.
Yeah.
So as I look at this, we're saying not much has happened this year, but truth be told, a 9% rate of return in the market is pretty solid.
Through the halfway point.
Through the halfway point, for sure. Now, granted, there's still 6 months left of the year, but the Russell being up 22% shows that diversification is working really well, and it pays to have small cap in your portfolio still. And then on top of that, you do have, I'll say, a pretty strong argument for diversification too, because there's actually a pretty decent delineation between the Dow and the Nasdaq as well. And the Dow has had positive growth this month.
Yeah, I mean, if you kind of think of the old school way of Dow being value and Nasdaq being growth, they're both working and not necessarily at the same time.
Yeah.
Right. Which is great. And probabilistically speaking, when you have this type of return this far into the year, you tend to finish higher than where you are right now.
Yeah.
June is, on average, one of the worst months of the year. And we saw that in the Nasdaq. We didn't see it so much in the S&P. I mean, if the worst month of the year is you're down like 1.5%, that's not a big deal. Yeah. And the Dow was up.
I mean, you look at these charts and there's been very little volatility this year.
Yeah.
I mean, compared to prior years. I mean, certainly there was a bit of a drawdown in April, but looking at this, the line has been pretty flat for the most part.
Yeah. I think that the concern that people have with concentration in the stock market, when you look at this chart, you say, okay, well, we have too much concentration in the S&P 500, but what about Taiwan, where they have like one company is 25% of this?
Yeah.
And it's working, right?
Yeah.
And the problem is that it won't work at some point. And when that happens, when, this build out slows down, that index is going down. There's nothing to keep it up.
The problem with that much concentration is if it makes up 25% of the index or more, then in order for it to shift out so there is more diversification, the momentum on that particular company would have to go away pretty much entirely for it to get, I'll say, diversified out to the other companies, which would mean inherently the index trades down dramatically.
Yeah. This is as if you are owning basically a single stock or like 3 stocks. Like
pretty much.
This is single stock risk essentially in an entire country. There's more to this story, which is interesting to unpack. And I was spending some time, this was the reason I was late running in here today is because I was looking at some of the rate of change on stuff.
Okay.
So Taiwan is one of the top margin users in the stock market. And I didn't get this chart over with you because I couldn't create it in time.
Okay.
So bear with me for a moment. But when we think about margin debt, right? Margin is essentially borrowing to invest or spend.
Yeah, it's a loan.
Right? It's a loan against your stock portfolio.
Yep.
The US has $1.28 trillion in margin debt right now.
Okay.
All right. That's an all-time record high that we reached just earlier this year. I think we fell back a little bit in June, but a lot of what happens with margin debt is it increases as the market increases, right? So if you buy something on margin and that something you buy goes up, then your amount of margin is also up.
Well, that makes sense inherently too, because if you have a client that has a $5 million portfolio and it grows to a $10 million portfolio, you're not going to want to sell those stocks necessarily to pay the capital gains versus a lot of people would opt to take a loan against it. Yeah. So as the stock market grows, it makes sense that margin goes up.
Well, yeah. And especially if you're using that margin to reinvest in the stock market.
Totally.
Which is, I think, what we're seeing more of. I know that there's a lot of borrowing against the portfolio to avoid capital gains, but as you'll see, some of the margin is being very intentionally used in a FOMO type of strategy.
A redeployment.
Yes.
Okay.
Right. Okay. So the US has $1.28 trillion. South Korea has $24 to $46 billion in margin. Japan has $41 billion. Taiwan has $19 billion. That doesn't sound like a lot compared to our $1.28 trillion, right?
But there has to be the size of the economies.
Yes. So that $19 billion that Taiwan has, that surpassed .com bubble levels. They have more debt now than
than we did in the .com bubble, essentially.
Yeah, or anybody did. So what we really want to focus on is the rate of change year over year in the margin debt, because we have the most margin, right? But it's actually only increased by 54% over the last 1 year. And when you look at the stock market returns over the last 1 year, it's not much lower than that. I mean, we're not up 50%, we're like high 30s.
Yeah.
But again, if we assume that margin debt is tied to the growth of the stock market, that type of increase is not astronomical.
Yeah,
right?
there's nothing outrageous about that.
Yeah. South Korea is up about 50% in their margin debt. So that's cool. They're just pacing us. Taiwan's up 160% in margin debt over the last 1 year. That's problematic.
Yeah, that's a little concerning. Well, that also speaks to the growth in the index in general, if it is being reinvested, because as we know, stock prices go up when people buy the stock. So if you're just leveraging up your own positions, then that's going to cause the index to rise.
And those positions are the same two stocks.
Two stocks,
right?
Yeah.
So it's basically just like, hey, I'm going to buy Taiwan Semi, and then I'm going to borrow to buy Taiwan Semi.
Yeah.
And when that goes up, I'm going to borrow
again
to buy it again. And it becomes a problem because it creates air pockets. Because if Taiwan Semi drops, then there can be margin calls where people are forced to sell stock more, and that further drives the stock into a decline.
You don't get a free ride on that margin, and there's interest associated with that as well.
Yeah. So that's interesting to me.
Yeah, that's pretty crazy to me. I did not know that. That's a fun fact.
Yeah, the reason I was picking on South Korea and Taiwan and generally South Asian cultures, when they approach the stock market, they look at it as trading, like primarily trading first, investment second.
Interesting. So not long term.
Right. Yeah.
Huh.
They're looking to get a quick return.
Interesting.
It's a more of a gambling approach to the stock market.
That's fascinating.
Yeah.
I did not know that.
I think it's something to keep an eye on. I think margin debt in general in this country being so high doesn't surprise me because, and it's some of this is like what qualifies as margin debt, right? Like what's actually reported to this survey. And I think that some private loans that are not technically margin don't get counted towards it.
I remember when I was first starting as an advisor, one of my first meetings with a prospective client was this guy that came in and he had a portfolio with, I don't remember how much, a couple $1 million just for story's sake, but it was margined up to about like 50 to 60%. Like it was max margined.
Right.
And he came in and he was talking about how he was so pumped that he was debt free because he took out a margin loan to pay off his home and like all these personal loans that he had.
Yeah.
And I was like, but you're not debt free. You have a loan. He's like, no, but I own it. I'm the bank. And I'm like, no, you're not. You're paying 8% interest on this loan. I'm like, it's still a loan.
Yeah.
So at the end of the day, if your portfolio goes down in value, like if you have $1 million portfolio that's levered up 50% on margin, and if you have, I'll just say 2008 rolls around again and your portfolio goes down in value, you're going to have to come up with that money.
Yeah.
Or they're going to start selling out of your positions.
Right. And that's the issue is that
it's going to enhance the drawdown.
It's the worst case scenario. You're forced to sell when your portfolio's down.
Yeah, and good luck recovering from that.
Yeah,
that's tough.
That margin drawdown can be really painful.
It can.
And there's like margins of safety, like just like that you should keep a certain percentage. If you are using margin, you shouldn't max out your margin. You want to keep it to a lower amount, right?
Right.
What's interesting about margin, and to that client's point, is that if you looked at his credit report, there is no loan. Right?
Yeah.
So it's somewhat sneaky.
It is very sneaky. Yeah, it's not always.
There's no underwriting for it.
No.
Yeah. So I think that there are certainly valid use cases for margin. I think when you're using margin to chase something, it's not the best strategy especially if you're being reckless about it. If you're adding like 10% leverage to the portfolio because you're very bullish and you think there's some near-term value to that, that's great.
Yeah.
But if you're at 50%, you should not be.
You're also super aggressive in your portfolio. That's a little.
Yeah.
I couldn't do that personally. I couldn't stomach that.
Yeah. Hey, what else happened in June, Colin?
Well, a lot happened in June, but one thing I want to focus on is actually CPI numbers in general.
CPI numbers.
Yeah. So not just CPI, but in particular, the Core Personal Consumption Expenditure Price Index.
Blah, blah, blah. Okay, tell us.
Blah, blah, blah. So basically that does is it basically tracks people's spending and it backs out certain things, in particular like food and energy. So it showed a 3.4% annual rate. So it basically rose a little bit for the month of June, which made sense because market's up slightly and whatnot. But what we're basically seeing here is when it comes to CPI in general, like inflation is being very, very sticky. Mm-hmm. And the Fed is now coming out, and we talked about this in prior podcasts as well. If you go back to the beginning of the year, people were expecting cuts this year. Now it's saying that inflation is being very sticky. It's possible that we could see an interest rate hike by the end of the year. So I do think that when we look at everything in regards to like our own personal lives, I know we talked about energy prices being up. Now the Middle East thing was in theory over. So they have come down a decent amount, which has been really nice. I actually filled up my car yesterday and it was like, save me $10. So that was good. So, but you're seeing food prices still pretty high, energy prices high, electricity is high, healthcare costs are high. So there's still a lot that's going on that has been very, very sticky. And I think that I would not be surprised if we saw an interest rate hike at the end of the year.
If you had to bet your livelihood on this, would it be hike, nothing, or cut?
Nothing.
Yeah, same.
That's probably what I would say.
I think they want to run the economy hot right now. And I don't know that they're worried about that inflation number. Yeah. The issue, I think, one of the issues is that wage inflation has not been sticky.
Not at all.
And that's something that was sticky, like following COVID for a little while. We have some charts on that too as well. But I feel like they just want to run this economy hot right now.
Yeah.
And it will take a little bit more for inflation, especially since some of this is quote unquote transitory, right? Like if this conflict with Iran is settled in the near future and oil prices continue to drop.
Yep.
Or how the housing market is really stalled out. So the increase in that area of inflation is slowing down.
Yeah.
I don't know. I feel like they're kind of, I think that this administration and the person that they've put in the Federal Reserve to kind of steer the ship feels like the solution to a lot of our problems is growth.
Yeah.
And grow our way out of it.
Yeah. I mean, that's true. If you look at consumer spending, it is very high right now.
Yeah.
So, and it continues to go up. But, and we'll talk about this a little bit more, and maybe I should just get into it now while we're on the topic. But personal savings rates. Did you see these numbers?
Well, we talked about this a couple weeks ago.
We did. But something that stuck out to me about the most recent numbers wasn't so much that the personal savings rate is basically at an all-time low, apart from one specific point in 2022. But did you know that 19% of people have a loan against their 401k currently? 19.6% of people that have a Fidelity 401k have a loan against it right now.
That's interesting.
Which is up 13%. So basically it was 13%. Now it's up to 19.6%. So Fidelity is basically reporting now that there are more and more loans, in particular hardship loans, against savings accounts than ever before than what they've seen.
Savings accounts or 401ks?
Retirement savings accounts. 401ks.
Okay. So 401ks. All right. Does that, it was 13% when, like last year?
Sorry, it was 18.8% at the beginning of the year, 19.2% now.
Okay.
So it's gone up. And then I guess prior years, it was more like 13%.
And they're qualifying a lot of these loans as hardship because you can also, like you say, basically, when you want a loan from your 401k, here's what I want it for. There's like 4 or 5 options. One of them might be a house purchase or whatever.
Yeah. And do you know the largest age demographic that has a loan against their 401k currently?
You want me to guess?
Yes. I'll break it down by the numbers, but
yeah, give me the groups.
Okay.
See if I can pick
so
it.
Gen X, millennials, and
Okay.
boomers.
Millennials?
No. Gen X.
Gen X.
Gen X, 25.5% of Gen Xers have a loan against their 401k currently.
25% of Fidelity 401k participants who fall into that Gen X category.
Correct. So between the ages of 46 to 61, millennials, age 30 to 45 right now, 19.6% have an outstanding loan. Boomers, 13.7%. So that's ages 62 to 80, which would make sense because they're probably going to have the highest net worth. So they're going to have the lowest amount. But if you think about Gen Xers right now, you probably have kids, a lot of people there. You probably have very high expenses right now. They're homeowners and things like that. But then obviously the lowest groups would be the Gen Zers.
Well, you know what Gen X needs to borrow loans for? College.
I was going to say, kids' college.
Kids' college tuition.
Yeah. And private school in general.
I mean, the reason, but especially at that age, that's more like Gen X is definitely at the point where they have kids going to college now. And as you and I were just talking about, the price of college is obviously at all-time highs.
Yeah.
I think there's all these different reasons that you might borrow against your 401k, and large, I would say, unordinary expenses like a college tuition. That's not something. It's like you have that for a period of time. You don't have it, and then all of a sudden you have a $60,000 annual tuition bill.
Right.
So I think that's a great reason, or a typical reason that you might see. Also, a down payment for a home.
Yeah.
Reason you might see some circular nature here, where people are borrowing from their 401k to invest in the stock market because they can't buy SpaceX.
I don't know about that. I think that's a bit of a stretch, but yeah, I mean, the rate of loans has continued to increase every single year over the last few years. To now, it's getting to a point where the average amount of, I'll say, loans against a 401k in America at Fidelity is 19.2% roughly.
I don't know if that actually bothers me too much. I got to say, I don't think it's a great idea. The rate of change is not that high. The total percentage is not that high. And we live in a country that is fueled by debt. So I guess I'm not shocked by it, and I'm not too bothered by it, because what's the average loan size as a percentage against the value? Because what that's not telling you is how big those loans are and how much interest is being paid on them, et cetera, et cetera.
Average loan to value typically ranges 65%.
That's bad.
60 to 65% is what it's saying here. So I actually think that that's kind of concerning, that 20%. What we're basically saying is not only have savings rates gone down, but people are saving less, and what they do have, they're borrowing against, and at a very high rate.
Okay, the savings rate thing, again, to go back to what we talked about with that, once you've saved, you don't necessarily need to save again. So the savings rate is a rate year over year, right? Like it's basically like how much did you save this year versus last year? But you don't always, it's not like I put 10% in my 401k every year, right? And that goes down. It's that when people save up money, they don't need to save up money again in order to spend. This is what happens when people feel confident in their spending in a lot of ways. So we look at the savings rate and we say, well, they're not saving as much, but that doesn't mean, what is the savings rate, right? Where's the money going? It's not that they're not investing.
Hang on. So, but the savings rate does have to do with the amount that you're putting into your investments.
No, 401k, but not your brokerage account.
Right. But hardly anybody actually has a brokerage account.
That's actually not true. It's increased quite a bit. Like think about how many accounts Robinhood has.
That's fair. But most people look at Robinhood as speculation, not long-term investment.
Correct. But that doesn't mean that they're not putting money to work. And that wouldn't qualify as a savings rate contribution.
So what we're saying is that the savings rates to retirement accounts have gone down.
No, what we're saying is savings rates to savings accounts and retirement accounts.
Right, to retirement accounts.
But both. So it's one category. It basically says these things equal the same savings rate. And we look at that. If you were asking, I don't know, Joe on the street about this, he wouldn't think my savings rate is my 401k. He would think savings rate is his savings account. And that's gone down.
So when we look at these numbers, and this is a clarifying question that I think we'll need to research, when we say the savings rate is 2.6%, it's only gathering your checking and savings account and your 401k?
We can double check that, make sure HSAs aren't in there. Or what, like knowing what's counted towards that is really important. But it's also like spending is increasing and saving is decreasing as rates, right?
Right.
So what gets lost in that is the fact that people have saved a lot of money. Let's say that you have a target for your savings account and it's $100,000. Let's say that.
Okay. Yep.
Once you've saved $100,000 last year, you don't need to save $100,000 this year if you have a target and you achieve the target.
Certainly, but when it comes to compounding growth, it is based off of a percentage.
Sure, but the last time savings rates were at like a real high was COVID.
Right. Well, that's because of stimulus too.
Stimulus and lack of spending on certain things, and then spending increased.
Right.
But savings accounts stayed high. The balance of cash, look at the cash on the sidelines, for example. We talk about this a lot.
Right.
That's at all-time highs.
That's true.
So how do you argue that the savings rate is an issue? Not you, but How does anyone argue, hey, we're not saving enough when there's the record high of cash available?
Well, I feel like that's easy to answer because we're in a K-shaped economy. So the cash on the sidelines is set aside by the haves, but the savings rates and the loans against the 401ks are typically against people that are the have-nots.
I would say I agree with you, the loans and the 401ks, but the savings rate includes everybody.
No, I know, of course it includes everybody, but I guess my point is that there's more Americans that make up the have-nots right now than there are Americans that make up the haves right now.
Right.
So as a percentage, that's overweighed by the people on the lower half of the K curve.
Yeah. I don't disagree with that. I think it's just that when this headline came up a few weeks ago and we talked about it, the fact is it's a headline that is a very messy number that doesn't break down what we needed to break down in order to really tell us what we need to know.
What factors in the savings rate is they look at cash savings, retirement contributions, 401k, 403b, traditional IRAs and Roth IRAs. They look at employer matches, which I didn't know. Cash deployed into taxable brokerage accounts and index funds and HSAs.
And cash deployed.
So brokerage accounts, index funds, individual stock accounts, and I guess this is talking about bonds specifically. So direct Federal Reserve bonds,
right.
And
people
HSAs.
buying bonds.
Yes.
So people buying Tesla don't factor into that.
No, it does. So transactions in brokerage accounts.
In bonds, though.
No. Investments, cash deployed in taxable brokerage accounts, index funds, stocks, and bonds.
Right. Well, index funds, too.
Yes.
So
any sort of additional savings in checking accounts, savings accounts, retirement accounts, employer matches, investments, and HSAs. So the way that the U.S. Bureau of Economic Analysis measures this on a macro level is rather than counting the Americans saved between these 5 accounts, what they do is they calculate the national income, back out taxes, back out spending, and assume whatever is left over is the savings rates, so that way they don't have to track it between those 5 account types.
That is horrible.
So essentially, whatever money you don't spend, regardless of where it's put, is the savings rate.
Mm-hmm.
Which would then, in my mind, make a lot of sense why it's gone down so much, because if inflation is higher and if wage inflation is not going anywhere, then of course the money left over is going down.
But what doesn't tell you is, I agree with that. And that makes sense. We're basically saying, like, if we're spending more,
then
there's less to save.
Right. 100%.
But that doesn't mean that it's a problem that you're spending more.
No, it doesn't.
Because it's total income and total spending. There are plenty of people.
What this is basically saying is, I think my take on this is that there's more people living paycheck to paycheck now.
I think that that's hard to quantify because people who will regularly say that they're living paycheck to paycheck while maxing out their 401k.
True, but I don't understand how this metric could possibly factor in the 401k thing. But the whole point of this was to go back and say, the 401k loans at 65% of 401k value at 20% of people.
That is an issue.
That is a really big deal.
If Gen X, basically 20% of Gen X 401k participants at Fidelity have a loan against their 401k with an LTV of 60%, 65%.
Correct.
Okay.
How do we get down that huge tangent about the savings rates?
I think because the question is, how much of an issue is this? Like, what are we concerned about? Because should anybody borrow against their 401k? Most of the time, no, but sometimes yes. So what are we talking about?
I think for me, the big issue is probably not the savings rate, but like a lot of the themes of what we talk about is potentially Social Security going away as well. And it's like, if Social Security goes away, no one's contributing to their 401k. And if what people have in their 401k has a 60 to 65% loan to value, there's not much left over at the end of the day.
Well, then I think what we're really talking about is risk awareness.
Yeah.
Because understanding the financial, I talked to one of our clients' kids yesterday, And he is going to college in the fall. He's got a summer job.
Yep.
And he asked his parents about opening a Roth IRA.
Nice.
And that's great, right?
It's awesome.
So they're like, hey, can you talk to our son? Just, talk about the ins and outs, the pros and cons, et cetera. So I had that conversation, and we talked about some of the things we talked about in the podcast, determine how much you want to save that. And then after that, guilt-free spend.
Okay.
Right? You're an 18-year-old kid.
Right.
He's not going to make the amount that he could put away in a Roth IRA. So it's not like he's going to be able to max fund. Right. But if he decides he's going to put $1,000,
that's a game changer.
Right. And when we did the compound calculation of $1,000 this year and then $100 a month for the rest of his working career and retiring at 60, he had
going to be like millions of dollars.
Well, no, it was $600,000.
Okay.
But he's not saving he's saving $1,000 a year.
Right. True. But when he starts working, it will go up to more.
But just if he only did that.
Mm-hmm.
Right. And then, let's say he earns actually $2,000 and he saves $1,000. His parents can match another $1,000.
Yeah, of course.
Right?
Yeah.
As long as he's earned enough to put that money away after taxes, then they can get that money into the Roth, and it will be like they're personally matching, his contributions, which I think is awesome, and I'm going to recommend that to them. But the point is, I think that we have to be aware of the decisions that we make, and that's basically what I said to him. That you could go take that $100 and go out with your friends, or you could take that $100 and put it into a Roth IRA, or you could do 50-50. Right. And whatever you decide has some sort of consequence, impact.
Totally.
Right.
Yeah. Yeah. It'll be interesting to see what ends up happening over the next 10 to 20 years with everything. But yeah, I didn't realize that there were that many 401k loans out there.
That is a little bit like anybody who has, I guess, PSA. If you have a loan against your 401k and you're not working with a financial advisor,
you probably should
find somebody to work with.
Yeah.
Fidelity has them.
Yeah, exactly.
Just go to Fidelity.
Stay in your plan.
Should this be my approach to whatever it is that I'm trying to do?
Agreed.
Let's talk about SpaceX.
Moving on. Yes, let's do it.
So SpaceX IPO, we survived.
Shall I pull up the charts?
Yes.
Okay.
Pull up the SpaceX price change.
Okay, got it.
All right. So SpaceX IPO'd, shot up to over 45% in return since the IPO.
Yeah, within like the first 4 days.
Came back to Earth.
Yep.
See what I did there?
Nice.
And is now hovering 27% up. The off the high number that you referenced is that it's 15% off the high.
Yeah.
What's interesting to me, aside from, I had this lyric in my head. I think it's like a Shania Twain song. It's like, looks like we made it. Like, we got through SpaceX. It looks like we made it. Anyways, what's interesting to me is if SpaceX is not exciting enough for you, you could always buy 2x SpaceX in an ETF.
Yes.
Did you know, Colin, you can also buy 3x SpaceX in an ETF?
Speaking of margin.
We can find leverage wherever we want. And now there's 3 times SpaceX. There's 3 times shorting SpaceX. There's XXX NVIDIA. There's XXX
I was going to say,
Micron.
It's not just SpaceX too. You've got everything.
Yeah. Now that's completely speculative. But this other chart I showed you is a percent off high for SpaceX, which is down 15.33%. And then the 2X is 32.28%. The 3X is not pictured because Y charts is like, what kind of junk are you trying to show me?
Not even going to bother screening this for me.
Yes. It's not good.
What's crazy is how quickly these indexes pop up.
Yeah.
Like, it IPO'd and then like 2 days later, you have 3x.
All you have an ETF that you can, it's almost immediate. Yes.
What is pretty crazy to me is that it's already speculation to buy an IPO as is.
Totally.
You have no track record of the stock whatsoever. There's no historical data on its performance or anything like that.
Mm-hmm.
And as if it's not enough to speculate, you have to really, really speculate.
Yeah. I need more speculation, please.
Yes.
And I'm also going to take a loan against my house and my 401k so I can buy.
So I can leverage this up even more. Yeah.
I want to have.
I'm sure I can't even imagine what the leap market is for this type of thing. But
if the float on SpaceX we talked about was like, I don't know, 5% or something like that.
Yeah.
If 5% of the company is available for public trading and we are triple leveraging our access to it. This is the type of stuff. This is like the Taiwan index,
Yes.
right? Like the fact that there's so much speculation, it never ends well. This won't end well.
Yeah.
And I think people need to be aware of the risk. You shouldn't be risk averse. You should be risk aware. And I think to your point that you're making earlier with the 401k loans, there's a lot of risk, a lack of awareness, right? Are people aware that they owe that money if they get laid off in a bad economy?
Right.
Right? Do they know that they have to pay that off right away, basically, or within 3 months, depending on the plan?
I don't actually think people know that.
Right. Or they don't see it as a risk. They're not seeing the risk.
Yeah.
And I think that it's worth pointing out the risk more.
I think for me, it almost seems like people don't want to make money slowly, which I think is a shame. You know, like
You're right.
Like everybody wants things really, really quickly. They want
Yeah.
these big pops. They want to be a part and not, have FOMO and whatnot. But I'll say every single ultra high net worth client that we work with that I know of made their money really slowly.
It's fair.
It took a very long time to get there, and it was just consistency.
Well, Warren Buffett, right? Like the majority of his wealth was generated after his 60s.
I was going to say, I don't even think he became a billionaire till he was in his 60s.
Yeah, I mean, that's the thing is that like he did a great job. Like,
he was still hundreds of millions of dollars.
Yeah, he was crushing it, and then it compounded upon itself.
Yeah,
and I think that's where we tend to enter like later on with a lot of these clients when they've already gone through the compounding. And there's probably opportunities along the way where they could have done more.
Yeah.
But you're right.
I was talking with a client about this the other day. They were retiring, great savers, did everything right. They never made like an astronomical amount of money. They both made $150 each. But they just contributed, I think it was 15% to their 401k from the day they started working at 22 years old to the day that they retired. And just was pretty much all S&P index and let it ride. Now they've got a couple $1 million. It's all good. But they were talking to me about the fact that they never really saw growth in their 401k until like the last 4 years, because once it got to whatever the number is, 20% was like a much bigger number. And then 20% on that much bigger number felt much bigger, and it accelerates. And that's Einstein's favorite quote when he was asked for the Nobel Prize. I think it was like quantum physics or something. They were like, what's the most powerful force in the universe? And he said, compounding interest.
Compounding interest.
But
that's true.
Yeah.
I think that, it's a good point, Colin. It feels shocking, but also it's nonsensical. Like it's, of course, that everybody wants everything immediately, and delayed gratification is harder and harder to come by.
It is.
And I wonder if that's kind of the market behavior that we see in the stock market now when we see all these V-shaped recoveries.
Yeah, like pump and dump.
Yeah.
I don't know.
Let's not talk about that, because this month we also saw the crypto report come out that shows how much money people made in crypto.
I didn't read this.
Okay.
So this was the one I didn't get to.
Well, would it surprise you to learn that the Trump family made $1 billion in crypto last year?
No, that wouldn't surprise me. But how much are they down this year?
Because they dumped, though.
Okay.
Dump.
Okay.
It's not Bitcoin. It's Trump coin.
Oh, of course.
Trump coin.
Yeah.
And fake things. We should talk about Bitcoin, but we don't have time to talk about Bitcoin.
Yeah.
I have 2 more charts.
Okay. And then I have one thing I want to talk about. Then we can wrap.
See how quickly we moved through the fraud and corruption. All right. So bring up that black chart I sent you, the Conference Board Consumer Confidence Labor Differential.
Okay.
All right. So what's interesting about this is, and I'm going to read to you real quick what this actually is. So every month, the Conference Board conducts a nationally representative survey of real U.S. households. Okay. So in this survey, they ask respondents to evaluate current employment conditions in their local area.
Employment conditions. Okay. So this isn't consumer confidence numbers. This is consumer labor confidence.
This is consumer confidence labor differential.
Okay. Got it.
All right. So they ask you, Colin Walker, hey, how do you feel about employment conditions in your local area? You define that, whatever.
Okay.
The choices are plentiful, not so plentiful, and hard to get. This is a national survey.
Wow. Insightful.
I read that verbatim. So plentiful, not so plentiful, or hard to get. And then you check one of those 3 boxes, and then they come up with this chart. And what
that is then circulated around to all the news articles to write and speculate on. Yes. Okay.
And you say plentiful, and I say not so plentiful. And anyways, more people are saying hard to get.
Just out of curiosity, what's your take on Portsmouth, New Hampshire?
What would I say about the job market here? Interesting. I feel like I see a lot of help wanted signs.
I would say plentiful.
Yeah. I mean,
I know of a lot of employers who are hiring right now just locally around us.
I guess it depends what type of job you're looking
I guess
for,
that's true.
right?
But that's the whole thing. That's like, if you're in the service industry, you probably are spoiled for choice when it comes to jobs. Like if you're waiting tables and things like that, I know pretty much every single restaurant is hiring right now.
But you're spoiled for choice, but you don't make any money.
Well, no, I know, but that's not what this chart's asking.
I know, yeah.
But if you're like a tech programmer,
living
in Silicon Valley right now,
then you might answer this very differently.
Might answer it differently. Yeah.
100%. I think that, again, this is like the conversation we were having about the measurements of the body water percentage, right? It's flawed, but directionally accurate.
Yes.
And what you're seeing here is that obviously we were leading up to a peak. We were at a peak before COVID in this chart.
Yeah.
And then COVID happens, and then everybody gets hired for 2 jobs at the same time, and we hit a new peak. And it's been slowly going down since 2021. 2022, obviously, there was a bear market at the same time. 2021, I believe, was when we started to see some of the big tech layoffs like Meta, et cetera. And it's just going down right now.
Very consistently.
Right. And so we're back to, let's call it the 2016 highs. And I think this is about feels, right? More often than anything not. But what's interesting is when you put this black chart against this beige chart that I sent you, companies that spend more on AI also increase work numbers. All right. So you're seeing the change in headcount measured by intensity of AI use or against intensity of AI use.
So what we're saying is that the more company spends on AI, the more likely they are to hire.
Correct. Wait a second. AI is supposed to put everybody out of
the
work. Yes. Now, I mean, that obviously can happen. These are small, like these are near-term numbers. Like the months since AI adoption, it's only goes up to 25, right?
This actually makes perfect sense to me.
Okay. Hit me.
Okay. As I look at the companies that aren't adopting AI, they're kind of behind the times.
Sure.
They're probably old. I think to myself, as the people who aren't adopting AI is like an outdated law firm. They probably weren't hiring to begin with. And the more they fall behind in regards to marketing, processing, operations, just general client experience, website stuff, I feel as if they're probably not going to keep up with times and revenue growth and things like that versus a company who is investing in technology and investing in AI and whatnot is probably very interested in growth.
Yeah.
And I look at our business as a whole right now, we're using AI in a lot of the technologies that we use. And that doesn't mean that people have less work. It just means more is getting done.
Right. Yeah, I think that's definitely been our experiential case is that like there's more to do because we can do more.
Right. Exactly.
And then, our business grows because of that.
Yeah.
So I think that this is a short term. I mean, we're looking at 2 years, right, with that chart of the AI adoption. I think that this trend, though, in the back to that chart with the consumer labor differential, or the confidence labor differential, I think that people are feeling really negative about the economy, and to recap, feeling very excited about the stock market. And that's interesting.
Well, I was reading as well. What was juxtaposed here with this was right before we hopped in here, I was just reading an article about consumer confidence levels. And the market went up big in June.
Right.
And
the consumer confidence levels went up in June?
Yeah. But that was specifically market related.
Okay.
But labor confidence went down.
Yeah.
And which speaks to the chart that you just pulled up. And certainly some of that has to do with what's going to happen in the Middle East. The market did go up. It was pretty much flat in June, depending on whichever indice you look at. But
you were positive. I mean, if you're diversified against those indices that we brought up, especially if you had Taiwan in there.
Yeah, exactly. Yeah, then you did pretty well. But yeah, I mean, I agree with you though, to your point that people feel pretty good about the stock market seemingly.
Yeah.
But not so good about the labor market.
I think people have been talking a lot about the K economy for a while, right? But I think it's bigger than that because our dependence on the stock market increases every year, right? We have the relentless bid for the market with 401k contributions on a biweekly basis. We have to, the point we made before, fewer pensions, concerns about Social Security. The 401ks essentially were put in place so you'd have, it was pitched as like you have control of your own destiny rather than, well, the company's on the hook.
I was going to say, but in reality, it saved companies millions of dollars.
But everybody's dependent on the stock market.
Right.
And I think the current administration's aware of that. And that's why they're investing in things like Intel, right? And, investing in the companies that are hopefully generating wealth for the country. But it just becomes more and more. I've always looked at this as a reason to feel very optimistic about the stock market because we rely on it. We can't afford for it to go down. But at some point, how much of a risk does that become? Can we as a country ensure that the stock market is too big to fail?
I am rewatching the Matrix series right now.
Well, good.
Kaylee and I are watching it. It's actually free.
Are you going to watch the fourth one?
No.
Come on.
I actually will watch the fourth one because why not?
Yeah, why not?
I'm not sure if Kaylee will watch it, but I'll watch it. And we're getting up to this scene, and you talking about this just reminded me of this when he can't sleep at night and he's walking with like the president of Zion underneath, and they were going for a walk, and there are all these machines going around the town filtering their water and processing their electricity and taking out the garbage and all this stuff, and they're talking about control. And they were talking about what is control and what are we subservient to, like as human beings and in the economy in general. And what he was talking about, Neo, was like, well, we have control over these machines because I can just go up and flip the switch off, or we could destroy them. And the leader was like, yeah, sure, you could go and smash them with a hammer. But is that really control when your garbage doesn't get taken out, your electricity stops working? He was like, there's a dependency here. And you don't have control over that because you would just need to create a new machine. So for us with the economy, we have a huge dependency on the stock market where I feel like it is too big to fail because we say that we're in control because obviously companies can go away, humans run the companies, we're buying products, whatever it might be. But if the stock market went away, what would that do to 401ks? What would that do to all the companies we know that operate, that we buy products and goods for? Like everything is stacked up on this system.
Yeah, it's end of days if it falls apart. And I don't think that's coming, to be clear. But I do think that sometimes we have to acknowledge a unpleasant truth and look at it as a potential advantage. And the unpleasant truth is that we are on the stock market teat, essentially, and we will never be weaned off of it.
Yeah.
And if you choose not to participate, you don't have as many resources working for you.
No.
You have to participate. You have to, we talked about last week, hope is not a strategy, but optimism might be. Obviously, you can't have it be irrational optimism because at some point there's an air pocket under Micron or whatever it is that you're gambling 3x on.
Sure.
But I think that you can be optimistic about the trajectory of your wealth if you participate and you regularly contribute and you make some good choices along the way, because the alternative is much, much worse than you can imagine.
Well, the stock market is a unifying thing, which I think in a world that's quite divided, it does give some solace to the fact that we are all in it together because everybody has to depend on it to some regard. Even if you don't participate in it, the companies that you transact with daily are very much affected by it. So even if you are negative on the stock market, you think it's stupid, whatever it might be, the fact of the matter is like it would be very difficult unless you're completely off grid or something like that for you to really go without it. And I think that is a nice thing to think about, because if we're all working towards the same goal, that does actually probably help us get there faster.
I think that's the nice rainbow colorful way to look at it. And I think that, the best thing that you can do, Josh Brown wrote something once about, investing in the machines, essentially, right? Like it's, they're going to be the future. They're going to be your future. They will disrupt and destroy in some cases. So the only way to survive is to bet on them.
Right.
And I think it's good, but at the same time, it's kind of like a pharmaceutical commercial where like side effects might include trillionaires, K-shaped economies, mobs in the street talking about no kings, and
the occasional 2008.
And you're going to have, if the stock market continues to be the future of dependency, the haves and the have-nots, and the discrepancy between the two will continue to widen.
Of course.
And the only thing that we can do, we talked about noisy national data today, and really it comes down to individualistic experience, right? Like that data means nothing to you unless you are actively a part of it. And the only thing you can personally do to try to keep up with the situation is invest in it and invest in yourself, and try to reconcile that, I think, with the fact that there will always be people who have more than
you,
all of us.
Right. 100%.
Yeah.
I think that's a good place to end it.
All right, cool.
Like, subscribe, share with your friends.
Dude, I didn't share with anybody last week.
It's not too late. All right. Thanks, guys.
The information in this material is for general information only and is not intended to provide specific advice or recommendations for any individual. Investment advice offered through Integrated Partners, doing business as Ko-Fi Advisors LLC, a registered investment advisor. Integrated Partners does not provide legal, tax, mortgage advice or services. Please consult your legal tax advisor regarding your specific situation. Past performance is no guarantee of future results. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful.
Compound Growth with Wheeler and Colin. Sponsored by Ko-Fi Advisors. Reach out today. Yay!